So hello everyone and welcome to this webinar that is organized by the Italian Post-Keynesian Network and the Post-Keynesian Economics Society. It's a webinar about economic modeling, and basically we follow up on a couple of webinars that we organized a couple of years ago. The purpose of the webinar is twofold. First, of course, we would like to use this as an opportunity to enhance the collaboration between the Italian Post-Keynesian Network and the Post-Keynesian Economics Society. And second, we also want to use this as an opportunity to promote and support the work of early career researchers. So today we are very glad that 3 early career researchers have joined us in order to present their work. And the plan is to have a 20 minutes presentation. Then there will be 5 minutes per paper by the discussant. And after this, we will have about 10 to 15 minutes for general comments and discussion. So let me start with our first speaker for today. This is Giuliano from the Levy Economics Institute, who is going to talk about a stock flow ecological model that they have developed about the Latin American and Caribbean region, which sounds very exciting. So without further ado, let me hand over to Giuliano. Giuliano, the floor is yours, and you have about 20 minutes for your presentation. Thank you so much.
Hi, can you hear me?
Yeah, yes. We can hear you well.
Okay,
if so let me share
my screen. Okay. Hope you can see my screen now.
Yeah, great. Please go ahead.
So, well, first of all, thanks for the invitation, and let me just say that this is actually it's a work with a bunch of actually co-authors. You can see there it's in order: Lorenzo Nalin, Lorenzo Rodriguez, and Esteban Perez Caldentes, and Jose Eduardo Latorre. Most broadly speaking, most from the sort of the Latin American region. And as a matter of fact, the title is a stock flow ecological model for Latin American perspective. Yeah. So what's the aim of the study? So basically, the aim of the study is to develop an ecological stock flow consistent model based on the Latin American style aspire regarding economic, financial, and environmental features. We sort of combine the macro financial theoretical framework put forward by Perez Caldente and others, and with the ecological modeling from Yannis and Maria, and also Carnevali and a bunch of Italian quarters. So we will discuss, basically, we try to discuss a scenario that tests exogenous climate-related shocks. That is the effect of imposing international regulation on commodity trade, which makes this commodity trade becoming more stringent due to environmental concerns, thus worsening the balance of payment constraint of the region. And we also simulate an increase in frequency and intensity of adverse climate events in the region, which will impact physical asset and cause supply and trade constraint. So this will be the sort of the plan of the presentation. First of all, we will try to disentangle some of the channels of both the climate change and transition policy and how actually will affect both the different aspect of the economic system. Then I will go to the sort of a brief description of the model, and then we'll also analyze some of our sort of the early results, and also draw some policy conclusion. So what about the climate rate transition channels? So yeah, so in our work, we mostly, and following a bunch of literature on this topic, we identify mostly two broad channels which connect the climate risk to the economic to the economy and finance. That is the physical transmission channel, which is mostly using the damage that arises from either natural hazard and will mostly impact productive assets. and also the challenge arising from the climate transition policies. That is the policy that aims to sort of reduce those so the human impact on the human impact on the sort of the on the socio-economic on the environment on the environment. And this transition may cause mostly some of the assets to become stranded and producing several macroeconomic and financial adjustments in this in the economic system. So both those physical and transition risk may actually impact the economy on a broad variety of channels, which we identify that mostly being five. So the first one will be the depletion of natural capital and natural services. It will be the sort of impact on the financial channel, on the financial side, and also the macro side, and the macro side from both the supply and demand. And there will be also an impact on the trade and cross-border flows and on the balance of payments sort of restriction. And finally, on the macro financial stability and also the banking channels. So what about the depletion of how both the physical risk and the climate natural capital and natural service? Well, for the physical risk, the impact is quite straightforward. You do with extreme events actually do make some serious damage to the physical capital, and in deteriorating natural capital actually also increases further the disaster risk, and usually also those physical risks are also associated with higher financial premium risk. From the climate transition perspective, or more precisely from the absence of those climate transition policies, this could actually causes a sort of a self-reinforcing process, which if regulation fails to intervene on some serious human and in human activities such as agricultural monocultures and cattle breeding, which may lead to soil erosion, deforestation, and forest degradation. As for the physical channels, from the standpoint of the physical risk, of course, this physical damage may affect both the government revenues and outlays. And from the climate transition perspective, this may implies basically phasing out, especially and this is the case for the Latin American region in particular, phasing out environmental harmful subsidies, and try to, in a way, to leveraging the potential environmental related taxes. This sort of substitution project may not be perfect, as we will see. From the macro side, as I mentioned, there are a variety of supply and demand shocks. From the physical risk perspective, which can again damage public infrastructure and private assets, and which also may cause some sort of pressure on price level, especially in critical sectors such as construction, raw material, transportation, and agriculture. From the climate transition side, this is, again, the policy those policies related to the climate change, such as carbon taxes, may actually have some negative effect on the economy, such as discouraging consumption on certain products. And in general, transition policy may also have some reflectionary effect. And finally, of course, actually, and for the trade part, of course, the physical risk actually do some damage also. Do damage on the infrastructure, and also harming sort of the trade, and also increasing the sort of the external restriction especially for emerging economies such as the Latin American one, and But and most importantly, the shifting global trade environment for the environmental standards may also does also the same effect, or do have the same effect of those increasing this. Finally, on the microfinancial stability, well, I mean, basically for the physical risk, as I mentioned, this so the impact of the extreme event will eventually effect of reducing the cash flow during the adverse event, and increasing also the share of non-performing loans, and have also some contradictory implication for monetary policies. And from the finally, from the climate transition side, and this will lead to so the effect of those policies may lead to stranded activities, again reducing cash flow during the cash flow, and increasing financial risk, and also to a certain extent, and so non-performing loans in the sort of the brown sector, leading to what Mark Carney defined some time ago as a climate, a sort of a climate Minsky moment. So this will be a small small summarize of our different channels. But without further ado, let's move to the description of our model. So why SFC? So many environmental process can be formalized throughout the stock flow relationship. So I mean, so basically to disentangle the interdependency in the economic system, and both both sectoral and especially if we do have a two region economy, also internationally, or or intra-regional. So the SFC approach can be used to study these issues related to sort of this ecological economics. Broadly speaking, there are I mean, this literature has been booming in the last few years. So broadly speaking, for the this SFC related literature, we can find three types of contribution. So I mean, one more, say, traditional, which trying with a more traditional SFC model, we try to put forward some multi-sectoral model, and try to analyze the energy transition risk. Another one more, I would say, empirical, which try to include within those empirical models, we got with medium-sized model, some sort of estimation of the carbon emission. And finally, the more, say, advanced ecological SFC model, which actually the stock flow funds model, put forward again by Yannis and Maria, and which actually try to analyze, to go deeper into the transmission channel from the environment and to the environment to the economy, and vice versa. And we fall mostly broadly within this. Our contribution broadly falls within the third category. So our model is mostly based on a macro open economy model, kind of traditional from the sort of the institutional sector side, with with some addition from the side of the financial and asset and liability side, as you will see in a moment. So this will be the transaction flow matrix. And well, since our mostly is since we have the rest of the world, it makes sense from the accounting perspective of the the material, the physical flow matrix and the physical stock flow matrix, to consider actually the material and energy balance from either the sort of the Latin American region and from the rest of the world. So it will be depicted in these two matrices. So let me go through some of the most innovative part of these models. So as for the risk premium and the nominal and interest rate interest and exchange rate dynamics, so we have as a main determinants of the sovereign premium, which the debt to GDP ratio, the foreign debt to GDP, foreign reserve, and exchange rate variation. The corporate risk, because we have a distinction between the sort of the private, let's say, corporate risk, and the sovereign sort of risk. So the corporate risk will be a function of the sovereign premium, here defined as MB, the current mismatches, the ratio of foreign liability to foreign asset, and the loans to GDP ratio. And the nominal exchange rate will follow sort of an autoregressive process of the one, affected by this chartalist and fundamentalist sort of interaction put forward by the Lavoie and Daigle in 2011. And the domestic interest rate will depend on international rate and the government risk, and the end to the excess supply for debt. Investment decisions vary according to evolution of capital depreciation and the performance of the investment confidence index. So this index depends upon the prospect of further returns, jointly with the growth rates of the domestic and foreign economies. And those profit expectations are a function of basically two elements: the return on investment and the corporate risk premium. As for the government, so the real government expenditure fluctuates according to sort of simple rule on which follows which is basically tries to is conditioned by GDP growth. And in case of extreme events, there are exceptional outlays by the government, and a fraction of that is issued in foreign currency. As for the central bank do demand the domestic bonds according to a target level, which depends on the behavior of the credit market and exchange rate. And this ideal amount of the central bank is willing to hold will depend mostly on the interest rate differential between the current rate and the central bank target rate, which follows a simple Taylor rule, and the observed volatility in the exchange rate. As for the rest of the world, and the rest of the world actually do demand government bonds issued in local currency. So this demand for the demand for government bonds issued in local currency will depend on global GDP growth, interest spread, and exchange rate expectation. And the demand for this government bond issued in foreign currency is determined by interest rate differentials. So coming on the feedback from from the environment to the economy, so we do postulate an orders like a damage function, which is kind of a stable of this, kind of a standard of this for this kind of model. But we also had on top of that the impact on the extreme events as in capturing a simple dummy variables. Which I mean is enacted as long as if there is if the event affecting a number of flow variables. The ecosystem model, it's again Bruce, it's pretty simple. Again, it goes output will require energy, and every year the industrial CO2 emissions are generated through the use of the non-renewable energy resources, and the CO2 concentration is driven by this emission and the carbon cycle among the different layers of the ecosystem. And the accumulation of this CO2 and other gases, it put our upward pressure on the atmospheric temperature. And finally, on the energy and material resources feedback on the economic system, those are mainly captured via two channels. So they do constrain investment decision, and thus output once the matter and the energy determined capacity utilization surpass the normal or the equilibrium level. And they also do affect prices via the markup on historical unit cost. Okay, so very briefly, since I'm not doing well in terms of timing, I will go through some of the baseline results. So our is sort of a mixed model. It's not fully calibrated. But we do have some. We do have calculation on some critical variable. And you can see here that actually through partial calibration, we still manage to have some decent replication. We need to get some replication of some macro accepted variable, such as the behavior of the exchange rate, the behavior of the gross fixed capital formation for the Latin America region as a whole, and the growth rate of, and keeping track of the growth rate of GDP, and to a certain extent also the total debt, either issued in local currency and issued in domestic in foreign currency, and to a certain extent also keeping track of the emission for both the sort of the Latin American region and the rest of the world. So as for our scenario, so what's, if we do analyze, so when we do analyze the effect of the change in technological dependencies, this imposed by sorts of this regulation on trade, via which we imagine will affect the economy via the impact on trade elasticity. Well, we first observed that that we will have the system itself will react by having a strong collapse actually in this of the growth rate of GDP in the sort of the first year of simulation, actually pretty huge, I think the order of minus 16%, sorry. Which then will actually reconverge towards a sort of a historical level of growth of the region, but having a sort of negative effect on the increase on the booming of the debt to GDP ratio via this sort of external financial restriction that we also capture via the different channels of our model. And also an increase of the premium, and thereby an increase in the either in the domestic and in the domestic interest rate, driven mostly by the increase of the nominal exchange rate, the volatility index, and the corporate and the sovereign risk premium. And with also a stagnation of the a collapse of the investment of GDP ratio, and also the sort of the profit to sale ratio. As for the increase in the probability of the extreme climate event, this scenario, in this scenario, we sort of increase the probability of which we imagine as having a sort of a normal distribution. So the idea was to increase the range to which to slowly increase the range of this probability over time, and increase sort of the tail of this range. So as an effect, we'll have reduction in the private expenditure, which then will trigger via, if you remember, we had the channel. We did postulate that the government will intervene to compensate for this fall in private expenditure, and triggering also the increase of a dramatic increase in debt in public debt, either denominated in domestic currency or in foreign currency. With a dramatic increase also in risk premium and volatility, and with a growth rate which will be still sluggish, but will try to recover based on this, based on the different forces joining, trying to either depress the economy, or to try to pump it up. Yes, and with and sort of the private debt sort of reacting to the increase of the likelihood of these extreme events. And to wrap up the discussion of this work. So basically, one can draw also based on our early simulation, where we can draw at least three sort of policy conclusions. So the first one is that some sort of coordination in environmental trade regulation is needed. That is, climate change is mostly a global issue. So unilateral action, which sort of punish emerging economies, may not be the optimal solution. It definitely is not optimal solution, especially for countries which have a strong bias toward commodity producing sectors. So yeah, based on this, based on the results, we can argue that a new international financial architecture is needed, since the adaptation and mitigation effort will be physically challenging if both financial instruments and sort of, in most generally speaking, the financial international infrastructure do not evolve to provide flexibility for borrowers and adapt the repayment schedule via their vulnerable cash flows and fiscal deficit position, especially for this country. Yeah, and definitely some green technological transfer will be needed to sort of reduce the exposure of both the transition and the climate risk, and or sort of overcome the productive structure of this laggard commodity dependent economies. So that's it. So sorry if I overstepped in terms of time, and yeah, I'm looking forward for your questions and comments.
Thank you so much, Giuliano. So I will hand over to Maria from the University of Greenwich, who is going to provide some comments on the paper. And after this, I will open this up, and I will ask everyone to make comments or questions. So Maria, the floor is yours.
Many thanks, Yannis, and many thanks, Giuliano, for your presentation. I really enjoyed reading your paper. So what I'm going to do is start with what I think are some of the strengths of the paper, and then I'm going to make some recommendations that could potentially improve the paper. And these recommendations will be in three different groups. The first one will be on the equations of the model, the second one about the calibration, and the third one about the baseline scenario analysis. So let me start with the strengths. As you said in your presentation, there are some ecological stock flow consistent models that have been developed over the last years, but most of them are global. They refer to the global economy. So I really enjoyed that you have developed Latin American and Caribbean region ecological stock flow consistent model, basically because this Latin American and Caribbean region model can understand and can investigate the effects of climate change. And we know that climate change is going to affect a lot the Latin American and Caribbean region, and also transition policies might affect as well the region. I also liked some of the equations that you have introduced, and the examples that I have on that slide are the ones that you mentioned pretty much in your presentation. So I really like that you have this volatility in the exchange rate, that this could affect the decision of central banks. This is the currency volatility indicator that you have in the paper. On top of it, you have this risk premium that is affected directly or indirectly by the volatility of the exchange rates. And this risk premium refers both to the government and to non-financial corporations. And I like the confidence index that then affects the investment decision. So then something else that I liked was that you don't focus only on emissions. In the paper, you also have some environmental aspects like energy and matter. And I particularly liked that you want to investigate the effects of the depletion of energy and matter on prices. We know that there is an ongoing discussion about the transition to a low carbon economy and whether this transition requires a lot of material, and some of this material might be depleted. So I really look forward for the results that you will have on this in particular. And lastly, one of the other things that I liked was that you want to replicate some of the stylized facts for the Latin American and Caribbean region. So let me now turn to some of the recommendations that I would like to make. And I'll start with the model equations. My understanding is that you have these total emissions, and then these total emissions take into account both the industrial emissions and the land emissions. The industrial emissions are specific for the Latin American and Caribbean region, and obviously they increase when we have more economic activity. But my understanding is that the emission intensity that you have included in the model is a constant, so it doesn't change. But I think that this is something that could be changed, because when we have some action from the firms or from the government, emission intensity could improve, so we could have less emissions based on that. So if you are interested in something like that, you could make the emission intensity endogenous, make it a function of, let's say, green capital, and this green capital could be of the firms or of the government. You have this Nordhaus formulation about emissions, CO2 concentration, and atmospheric temperature, and you have this carbon cycle and the radiative forcing. But I'm thinking that this formulation of Nordhaus gives a high temperature for a given emissions compared to what we get at the IPCC scenario. So you might want to consider an alternative formulation for emissions and atmospheric temperature. So the reference that I have on the slide of Matthews et al. Actually have a formulation that links directly cumulative emissions with atmospheric temperature, and the increases in temperature is more in line with what we have in the IPCC scenarios. Then in the model, you have global land emissions. So I was wondering whether it makes sense to think of having land emissions for the Latin American and Caribbean region, and then land emissions for the rest of the world. I'm saying that because you have that the Latin American and Caribbean region might play an important role for this global land emission. I'm thinking of Brazil decision for deforestation or reforestation. So you might need to think about that. Another thing that I was thinking that you might want to change it was about loans. So you have firms, they take out loans. My understanding is that these loans in local or foreign currency are provided on demand by the banking sector. It might make sense to consider some supply restrictions, especially this is the case if this risk premium that you set for corporation might be relatively high. They might not be able to repay the loans in another currency, in the foreign currency. So probably the financial position of firms, the financial position of banks might be taken into account when banks provide these loans to the firm sector. You have included damages. Damages affect private investment. You could also consider whether damages could affect some other components of demand, like consumption and exports. And this might be especially important for the case of exports in the Latin American and Caribbean region. And then you have also damages affecting the production. So my understanding is that this might show the supply effect, but I think you need to justify it a bit more. So why you have the damages separately affect the production. Then we know that there is a lot of discussion about developing countries, that they have to spend a lot for climate adaptation in order to deal with climate change over the next years. And we know that the Latin American and Caribbean region has to spend a lot for climate adaptation. So you might want to incorporate something like that, and this could have both positive and negative effects. Obviously, the positive effects could be that you will have less damages, you might have more employment because more jobs will be created, but at the same time, it's a kind of a cost that probably the government might have to pay. So the government to GDP might go up because of this climate adaptation spending. Now, I have some other comments about the way that you have calibrated the model. I know that, and you showed these nice graphs in which you present the actual data with the simulated data that you have in your baseline scenario, but I'm not sure exactly the way that you get this. My understanding is that you use some parameters, but probably you need to explain the exact parameters that you use in order to do this, to replicate the past time series. And it might make sense to use some other figures, to provide that you to validate your model. So usually you can incorporate a so-called autocorrelation or cross-correlation figures, in which case you compare the correlation structure of your data, the simulated data with a correlation structure of the actual data. Another thing that you could consider is about the initial values of some of your macroeconomic variables or environmental variables. My understanding is that the starting year of your simulations is 2021. So you might want to consider if you want to have exactly the same initial value in 2021 with the value that you get from the actual data. My understanding is that this is not the case right now. Then we know that with modeling and with stock local system models, we have a lot of uncertainty, a lot of parameters that, they are a bit arbitrary, but in some cases we can econometrically estimate some of these parameters. So you have some behavioral equations like consumption, investment, and exports. So you could check if you can do that. You can use panel data, for example, for the Latin American and Caribbean countries. Then the last thing that I want to say about the calibration is about the sources that you use in order to calibrate some of the variables that you have, especially for the macroeconomic variables. You mentioned in the paper some of the sources that you use for the Latin American and Caribbean macroeconomic variables, but it's not clear if you do something similar for the rest of the world macroeconomic variables. So what are the sources that you could potentially use in order to calibrate better the rest of the world? But probably you can do that easily. The last slide that I have, and I will stop after this, is about the baseline and scenario analysis. My understanding is that the simulations that you have shown largely rely to physical effects, but we know that we might have transition effects, not only in the Latin American and Caribbean countries region, but also because of green policies that might be implemented in the rest of the world. So these green policies could be anything like carbon taxes or green subsidies. So I'm thinking what the US does right now with green subsidies. These green subsidies that the US has might affect the Latin American and Caribbean region as well. So you might want to think if you want to introduce such a policy. And then I'm thinking about the results and the robustness of your results. Usually what we do is to try to identify potential channels. In some cases, we have some conflicting effects. So when you present some of the results, we can see these results are basically because the positive effects overwhelm the negative ones. So if you identify if in some cases there are conflicting effects, I think this would help. And usually we have a group of parameters that are in line, are linked with the specific channels. And if you do that, then you can do some sensitivity tests by using these parameters that are important and check obviously the robustness of your results. And lastly, and I'll finish with that, Yannis, sorry about it. I like very much that you have these different types of debts, private debt, government debt, foreign debt. It reminds a bit of a Godleian analysis. So you might want to introduce some figures about what is happening about different debt or the financial balances. And that's it. Many thanks for your work.
Great. Thank you, Maria. We don't have so much time, but I think we can spend 5-6 minutes for a general discussion. So, Giuliano, if I may, I would suggest that we get some comments and questions from the audience, and then perhaps you can respond to all of this. Okay. Please raise your hand. You can also use the chat box if you would like to type a question. Of course, I think it's easier for everyone if you just talk. So I would like to start with Eric. Eric, yes, please go ahead.
Very much. Yes, thanks. Very nice presentation. One comment, one question. So the comment, I want to reinforce Maria's point about the damages on the production side. I found that to be quite important, that looking at damage to the capital stocks in particular means that you lose some productive capacity that has to be rebuilt, and the rebuilding then has implications on expenditure, employment, and trade. And that's just not captured with the Nordhaus type model. Another one is, so my question is, how rapidly do you have Thirlwall's law act in your model? Because you've got short-term dynamics, but Thirlwall's law is really long-term. And I'm wondering if you were to allow some imbalance there and then have it adjust, if it could improve your calibration. Thanks.
Thank you, Eric. Felix.
Hi, thank you for your presentation. I have just one short question also about the Nordhaus damage function, because I was wondering how you decide or how that looks like, because as far as I remember, the defined model has it set in a form that proportional damage that come out of this damage functions are set at 0.5, I think, at the 4-degree threshold. And if this damage function maybe has lower impacts, or how does this compare?
Thank you. Is there any other question or comment before I get back to Giuliano? Good. So if not, just a very short question from my side. Could you say a little bit more how you connect inflation with the energy and material depletion ratios? Because I think Maria also mentioned that this is an interesting aspect, but sometimes it's a little bit challenging because we don't know when an increase in the depletion of a specific type of matter or energy might have an impact on prices. So I was wondering how exactly you do that, if you have non-linearities there. If you could say something more about that would be great. Thank you. So we don't have so much time, so I'll just hand over to you, Giuliano.
Okay, well, first, thanks all, and particularly Maria, for all the all the comments and questions raised from the discussion. So we'll try to wrap up. I mean, the main point. So first of all, will be sort of the damage function. Yeah, I mean, we do agree. Actually, we do agree that this Nordhaus type function is quite has some pitfalls, and then that's why we try to in our model we try to have this sort of extreme event, sort of additional impact, additional impact to sort of reinforce sort of this and to complement this this Nordhaus sort of type function, which as it stands right now, it's basically mostly follows the sort of the Nordhaus approach. So I mean, it will be following the same parameter, it will having the same calibration. But yeah, we were also discussing a different for future development of damaging function. So this is definitely something that we'll take into account, and then we'll look at the reference provided by Maria, and so to try to improve this impact any further for the impact further. So as for the as for the markup equation, this is modeled simply as a function of these, and this is again pretty simple and definitely should be improved as a function of the energy and matter utilization rate. A different way, perhaps we didn't have time to plot it into the model, could be to follow the same rationale of the investment function. That is the constraint on investment function. That is, once actually there is the actual capacity surpass the normal capacity, then you do have an effect. They do have this positive effect on markup. So this could be actually a way, which I do think perhaps, I mean, personally, perhaps it will follow more the rationale rather than being a simple, function of the capacity utilization. So the capacity utilization, sorry, the energy utilization, energy and matter utilization rate. Yeah, and then yeah, and definitely, yeah, we can definitely work. And then again, since we were actually trying to split up the sort of analyze the model in 2 steps, that is, first perform some sort of having a separate discussion of the adaptation and mitigation policy, we decided to focus more on the impact on the economy on shock, on having a shock on different variables. And as for the tier wall dynamic, yeah, I mean, yeah, one way, could be actually you can see, I mean, so this is pretty interesting actually, because we did get when we had this impact of when we actually shocked actually we do have the shock not just on the import elasticity, on the income elasticity or import, but also on the export, on the income elasticity or export. And we do have this negative shock, but then the growth rate you see will immediately converge, even though there will be some sort of hysteresis, but simple hysteresis. So yeah, I mean, the idea was trying to sort of having a more interpreting the restriction more from the technological side, rather than having more sort of an adjustment, rather have sort of a more sort of long medium-term dynamic. But we can definitely try to having a discussion on it. And yeah, yes, and then endogenizing. Yes, in the initial, finally, sort of we do have actually some initial values. I mean, we do have the calibration from some initial values of our model. In particular, I mean, for this, well, I don't have. I will try to remember by heart, but we have the initial values for the GDP growth rate, obviously emission for both the Latin America and the rest of the world. The figures that I show you, I mean, basically when they're trying to describe the baseline. So I mean, gross fixed capital formation, the stock of debt either in domestic and foreign currency, and and some figures from the government sector. And yeah, again, I do agree with you that the presentation of result could be improved by sort of having a more sort of Godley type discussion or showing the 3 balances. So yeah, thanks for everybody for the comments, and in particular for Magia discussion.
Thank you, Giuliano, for the great paper, and we look forward to reading the next version. Thanks a lot. So let me now turn to our next speaker, who is Collin from the University of Cambridge. And Collin is going to talk about debt sustainability. And my understanding is that with this paper, he's calling into question the traditional debt sustainability analysis. So we very much look forward to what you have to say about this. Collin, over to you.
Thank you, Yannis, and thank you for the invitation. Just give me 30 seconds to pull this up. Is it full screen? Oh, there it is. Great. All right. So the paper is called Throwing Darts and Missing the Bullseye, Fiscal and Debt Sustainability in Open Economies. All right. So the problem, as I understand it, is that debt targeting fiscal rules will miss its target, and they will miss it in a specific way. They will engender foreign exchange or debt crises, whether those are domestic or external debt. So there'll be some kind of cyclical oscillations around what I call stock flow equilibria, the bullseye. The key problem is the standard debt indicator combines a stock and a flow, whether it's domestic debt stock or GDP flow or external debt stock and exports flow, right? So if we're going to use this indicator, and of course the alternative measures of debt sustainability, if we're going to use this indicator, then of course it requires some kind of stock flow consistent framework. Yeah, and when I speak of debt sustainability, I'm thinking in terms of stationarity, a stable debt to GDP ratio, just to be consistent with the Demar condition, for example. All right, just a brief illustration of the problem. So what we have here on the y-axis is the primary balance sheet GDP, And this is for a fixed peg. So this is the central bank stock of foreign assets. Yeah. So a higher stock of foreign assets of the central bank, the economy can grow at a faster rate in the longer term. So the debt to GDP ratio may fall, and therefore we need a bigger primary deficit to stabilize the debt to GDP ratio. So there's stock equilibrium here. All right. A higher stock of foreign assets means that private sector demand would be high, and government would need to cut expenditure for goods market equilibrium. So this is the flow equilibrium here. Stock flow consistency, of course, is the bullseye. The problem is, for example, in quadrant 1, right, we will have trade deficits, excess demand, collapsing debt to GDP ratio. And if we have a debt targeting rule, or if we're obsessed with the debt to GDP indicator, then it means that we can spend more. Yeah. So this is the procyclicality of fiscal policy. This kind of fiscal conflicting fiscal requirements, because of course it means the economy is overheating. Or what happens if we spend more? Actually, there's going to be a foreign exchange crisis that we observe routinely in Latin America, the Caribbean particularly, and there'll be some kind of debt crisis, recourse to the IMF. Yeah. Now, if you think in terms of the tangible rule, then we have 2 different targets. We need 2 instruments. I'm going to say more about that at the end. The big point I want to make here is if we have a debt targeting fiscal rule trying to be placed on the purple line, for example, and we ignore flow equilibrium, then we're going to miss our target. This is just some phase diagrams for Denmark and Barbados, indeed demonstrating similar dynamics as it relates to counterclockwise. So foreign assets, for example, here are transformed into months of input cover. We know the international recommendation is 3 months of import. Anything below that, then we're potentially in problems. All right, so the standard model starts with government budget constraint. Yeah, and after some manipulation, we end up with this dynamic equation here. And it leads, of course, to a big fiscal rule or big result. That result is under the assumption of dynamic efficiency, and the classical theory will tell us we expect that to hold in the long run, meaning R is going to be greater than G. And if B dot must be 0 for debt sustainability, this must be negative. In other words, we need a long run primary surplus whenever R is greater than G. Yeah, and this result holds under another assumption. They assume away monetization. Other variations of this would include money creation, and therefore we talk about inflation dynamics, and then we can talk about whether or not money creation reduces the real debt burden, etc. What I do is I start from the goods market clearing condition. Then I introduce stock dynamics. So that's the whole idea of trying to account for flow equilibrium. I also, like the standard approach, ignore money creation, though I do that at the end of the paper and certainly in the appendix of this presentation. But actually, H dot still shows up, and that's because I'm thinking about endogenous money creation. So I'm trying to account explicitly, unlike this standard approach, for banking. Yeah, so H dot will show up in my model, but it's going to be endogenous money creation. I'm going to sum domestic debt and foreign currency debt. So this includes, of course, external debt in the same framework, unlike the standard approach. Now, the big result I find is that unless the weighted interest rate growth inequality is implausibly large, we need a primary deficit actually to stabilize the debt to GDP ratio and goods market equilibrium. And if we follow that stock flow consistent fiscal rule, then we would remove any overshooting or undershooting of the bullseye. All right, related literature. So this is an open economy version, if you will, of the Demar condition. So it's foreign interest rate, and this is, think of this as the balance of payment constraint growth rate. So whenever R is greater than GBP, we need a long run primary surplus. So there's big interest, of course, in this interest rate growth rate inequality. There are other versions of this. Me and others say actually it's stronger condition than this. It's R must be greater than G minus alpha, where alpha is the semi-elasticity of R with respect to debt. I don't get into those specific dynamics in this paper. That's something I want to do going forward. Yeah, but the whole idea is changes in the debt level would affect R itself, and we need to account for that. So the requirement is not just R minus G. Risks take a different approach. It's not about G. For risk, it's about the marginal productivity of capital. If R is greater than that, then we need long run primary surplus. Yeah. Now there are other works. This is a new paper that rediscovers, I think, a very old idea. And the old idea is that fiscal deficits can pay for themselves through 2 channels. They can lead to a boom in economic activity, increase the tax base, that GDP ratio can fall, right? Or if that channel is not particularly strong, it might lead to inflation, and that will reduce the real debt burden. Yeah. So longer fiscal deficits are not necessarily impossible, according to this rediscovery of the old idea. Now, Godley in the Farm, it's the 2007 in a closed economy setup do provide some simulation results that show we could have a primary deficit in the long run and stable debt to GDP ratio. They do have open economy simulated results in this particular paper, but those open economy simulations are not interested per se in debt dynamics. They're more interested in current account balances, current account stability, etc. Yeah? So I, in a sense, reinforce Godley's closed economy result with specific channels and some intuition. All right, just a few words on the environment. So I'm thinking in terms of rich and poor households. Poor households are too poor to save. So when we think of investing in government debt, we're talking about rich households. Yeah? There are firms, banks, and there's a consolidated public sector, central government, central bank. The original sin holds, so there is external debt denominated in foreign currency, and rich households, their balance sheet approximate the net worth of banks and firms. In other words, rich households own banks and firms. The redundant balance sheet would be the consolidated public sector's balance sheet in my setup. In the paper, I have a fixed exchange rate and a pure float or flexible exchange rate setup. I'm just going to present the results for the fixed peg, but I'm quite happy to talk about the flexible case. Capital flows are sterilized, and I'm assuming no monetization, though I relax that assumption in the paper. Even though there is no monetization, the money supply is endogenous. H dot shows up in our model, unlike the standard approach. All right, so we start from the familiar goods market flow condition. All right, this is a primary balance, this is trade balance, saving investment balance, and this is interest payments. All right, so identity 2 tells us that we could have a trade deficit if the public sector borrows from the world market, with of course debt denominated in foreign currency, or if it reduces its stock of foreign assets in the central bank. Similarly, we could have a trade deficit if rich households borrow in world markets, or if they reduce the stock of foreign assets. So this C is corporations, think of firms, the small B would be banks. Yeah? Banks, if they reduce the hoards of foreign assets, then we could import more than we export. The same with investment dynamics. So commercial banks save by holding bank reserves, government securities or foreign assets. Corporations save by holding government securities or foreign assets, and this would be the stock of external debt undertaken by the corporation. Again, these are basically the balance sheet of the rich household. All I'm going to do now is substitute 2 and 3 into 2, and we get what looks like the government budget constraint that we derived moments ago, but it is not. Yeah. So I'm going to sum these. I'm just going to call it B dot. Yeah. So that's, when I think of debt, I'm thinking of domestic and external debt. Sum together just for simplicity. This H dot, again, it's all about endogenous creation. Yeah. After some manipulation, then we get 5. A related version to the Domar model, except there is H dot and now there is F dot. Now this R is not the same R as in the standard model. This is the weighted real interest rate, and the weights relate to external debt share of total debt. Yeah. All right. I'm trying to be as simple as I can. So this is just the evolution of high-powered money. In other words, banks are going to borrow from the central bank whenever they extend credit. So BP is the stock of private sector debt. Yeah. Now, central banks have a target stock of foreign assets that they would like to hold, and that target is principally determined by the stock of external debt or debt denominated in foreign currency. Again, I'm erring on the side of simplicity here. One can imagine more complex dynamic equations. I'm just going to substitute these equations into 5, and that gives us our standard result. All right, and that's equation A. Again, similar to the standard result, that is the Domar model with some bells and whistles. First of all, we have, so lower cases are share of the GDP, and this omega is the primary deficit as a share of GDP. So first of all, this is private sector debt as a share of GDP. This is high-powered money as a share of GDP, and this is stock of foreign assets held by the central bank as a share of GDP. This is the real rate of interest, and this is the stock of external debt. That is your growth rate. Yeah. The big result that I want to emphasize here is that our primary deficit will stabilize the debt to GDP ratio if and only if the following holds. If the sum of private sector debt as a share of GDP and foreign assets held by the central bank as a share of GDP is greater than these. All right. Now, efficient banks are going to try to minimize H, that is the amount of reserves to borrow from the central bank. Because of foreign currency risk, alpha has an upper limit, that is the share of external debt and total government debt. All right. Now, This is a large number, obviously. This is a recent study, but this is a very large number. I do not think, of course, this represents the average emerging market, or certainly countries in the Caribbean or other parts of Latin America, right? But we do know developing economies hold lots of foreign assets, yeah? The stylized fact in terms of private sector debt can range from 50% of GDP to more than 100% of GDP. So we're talking about specifically large values here. In my view, right, given reasonable parameter values for R, alpha, and G, this will unambiguously be positive, right? Such that a primary deficit will stabilize the debt to GDP ratio. Now, the issue is when we think of a primary deficit, it means government must routinely issue debt. And I think, particularly for mainstream audiences, the issue is how do we reconcile a persistent deficit with a constant debt to GDP ratio? The standard, of course, reaction is the inflationary channel, reducing yield burdens, and the tax base. But there's lots of innovations to undermine those intuitions, meaning recording equivalence, etc. I have three major channels in mind. A demand constraint channel, meaning the demand for government debt is not infinite. There are limits to how much debt you want to hold. Yeah, and then there are some voluntary and forced savings mechanisms that will ensure the debt to GDP ratio will not explode without limit, even if we have a permanent or long-run deficit. So I'm going to start with explaining why private sector debt to GDP ratio reduces the debt to GDP ratio in the long run. Right. So first thing is, if there's an increase in the private sector debt share, there's going to be a reduction in government demand. Reduction in demand for government bonds for two reasons at least. Right? Firms are going to save in government bonds to repay debt. All right, that's an obvious channel. Or maybe they reduce their bank deposits to repay debt. And if they do that, then bonds to deposit ratio in the banks are going to rise, and banks are going to reduce the demand for government bonds. You must remember, banks hold government bonds. So I'm from the Caribbean, and I can tell you that 99% of domestic bonds are held by banks, for example. Yeah, so this is a very important channel, particularly for low income countries. All right, larger stocks of foreign assets held by the central bank. The obvious channel is, well, the government is a net saver, so to speak. So debt to GDP ratio should fall, or they use that reserves to repay external liabilities. Again, debt to GDP ratio should fall, right? But the other channel that I find more interesting is whenever a central bank holds more foreign assets, it means the private sector can increase the demand for imports without compromising the peg or the fixed exchange rate in this particular case, right? So how are they going to import more without compromising the peg? Households and firms are going to sell government bonds to buy foreign assets to increase import demand, whether it's for consumption or investment purposes, right? Or they're going to reduce their bank deposits to acquire foreign assets. And the same channel kicks in again. There's going to be a reduction in demand for government bonds in the long run. The big point I want to make here is that the minute we think about central bank accumulation of foreign assets, the minute we think about private sector debt, there's going to be a long-run constraint or a longer demand constraint for government debt. The voluntary and forced savings mechanisms are as follows. So endogenous money here, the small h, high-powered money is a share of GDP. Imagine this as a transfer of wealth from debtor to creditor. So H will only rise whenever banks extend credit. All right. So an increase in H illustrates a transfer of wealth from the borrower to the lender. So there's an increase in interest income, and we save that in many assets. All right. So that increased interest income will be saved in many assets, including government bonds. Right. So endogenous money, and that's why an increase in H accelerates the debt to GDP ratio. And again, this is not money creation in the standard sense or monetization of the deficits. Obviously, external debt share alpha here will accelerate the debt to GDP ratio. And the channel I have in mind is the following. So think of a small open economy, say Barbados, for example, or Brazil. The government is going to require the central bank to quarantine more foreign assets to service external liabilities. That means there's less foreign assets available for the private sector to engage in consumption, investment, or savings in foreign assets. Yeah. So what do they do with their excess local currency savings? They'll store it in many assets, including government bonds, and this is what I call forced savings. All right. And the big point I want to emphasize again is a permanent fiscal deficit is perfectly consistent through these different channels, with B dot being 0. Yeah, providing that, of course, this is greater than this. And I do think the minute we start thinking hard about parameter values, that is indeed the case. Never mind the empirical evidence that we do not observe long and primary surfaces. All right, so I like this quote. It's from an IMF paper, a fairly recent one, 2011. Sustained large surpluses have been less common. Out of a sample of 87 countries, less than 20% sustained primary surpluses. And I can tell you that 20% or the less than 20% that sustained primary surpluses are all commodity rich. So either major gold exporters or major oil exporters. We just don't observe in the data sustained surpluses. By way of summary, the key result is there's nothing peculiar. There's absolutely nothing peculiar about a primary deficit, stabilizing debt to GDP ratio, and of course the goods market. And there are three channels that we can think of, and I'm sure if we think hard enough, there are other additional channels that we could explore. As it relates to policy, well, we shouldn't just follow any kind of fiscal rule, right? It shouldn't just be a debt targeting fiscal rule. There should be a stock flow consistent fiscal rule, right? And such a rule requires a primary deficit, and we can solve for the specific primary deficit given by omega star here, for example. Yeah, given the formulation of the model, we can also try to determine what should be the optimal stock of foreign assets to hold, etc. Now, in my view, this undermines the Tinbridgian rule, which requires any instruments for end targets. Here we have one instrument, and that is fiscal policy, and the targets would be goods market equilibrium, full employment, and debt stability. Well, that's why it's stock flow consistent. I don't think there's anything peculiar there. There is, I think I have some time, just very quickly. Now, this is an interesting paper that shows we have two targets, two instruments, one for price stability, the other for debt stability. Now, these cycles are non-trivial here. So if you think about the graphs I showed you earlier, these cycles would be one of inducing or creating foreign exchange shortages, yeah, or creating balance of payment issues. And it's the cycles that we should try to avoid. And that's why I'm emphasizing perhaps we should take seriously an FCC fiscal rule. I am going to end there. Thank you very much.
Thank you so much, Collin. So now we have Alberto from the University of Greenwich, who is going to provide some comments. So Alberto, please.
Hi, everyone. Can you hear me?
Yeah, very well.
Okay, so I don't have a presentation as Maria did, but I have a list of points I did for myself. I'm getting older, so if I don't take notes, most of them will be forgotten quite soon. So let me start, however, with the strength of the paper. First of all, I think I really enjoyed reading it. I think this is a very topical question right now, since that we are progressively returning to a period in which fiscal rules and concern about public budget stability is returning to the forefront of policymakers. At least in Europe, but I think also in other countries, take into account the recent discussion in the US about the ceiling to public debt. I think it is very interesting also Collin's attempt to contextualize the traditional DOMAR public debt stability rule in the context of a stock flow consistent model with some explicit formalization of that stock flow consistency augmented DOMAR rule for debt stability, something that has spotted and mentioned in the paper Godley and Lavoie already did in a paper published in the Journal of Post-Keynesian Economics in 2007, and in a chapter of their book, but with just simulation without a kind of formalization of that relation, and also expanding a little bit the open economy context on which Godley and Lavoie just very quickly touched upon at the end of their paper. So having this formalization is very useful. And from the point of view of policy discussion, I found very interesting the discussion of how in an open economy, debt monetization could jeopardize the sustainability of public debt, at least of foreign debt, if this could create expectation of a depreciation of the exchange rate, because obviously this increases the burden of foreign debt. And I think this is very important, in particular in policy discussion with supporters of modern money theory. Well, obviously, they would say we don't need a fixed exchange rate regime. We don't need to issue debt in a foreign currency. But obviously, from the point of view of many developing and emerging economies, it's not possible to get access to international financial markets with debt denominated in domestic currency. So the idea that the inclusion, Collin's inclusion in its paper of the original sin makes sense from my personal point of view. So very interesting paper. I think that the shortcomings of this paper, first of all, it is one shortcoming. One big shortcoming from my personal point of view is the fact that this is a paper with a stock flow consistent model without any matrices. And this makes the reading very hard. To be honest, I spent a lot of time trying to understand the connection between the different institutions, different sectors, and there are many institutions and sectors connected to each other without balance sheet matrix, without a balance sheet matrix, and without a stock transaction flow matrix, it's very hard to figure out what you are effectively doing. So I would very much suggest you to include those matrices, because otherwise it is very hard to understand the connection between sectors and if your model is really stock flow consistent. By the same token, there is something weird from my personal point of view in your stock flow consistencies. For instance, you have the distinction between poor and rich households. And when you talk about poor households, you make the assumptions in many steps of your model that the stock of their deposit is equal to the stock of their loans. So basically, you are assuming that poor households have permanently zero net wealth. It's not clear to me why. So if you go to many other stock flow consistent models, it is perfectly possible that households, rich or poor household, whatever you want, have a net wealth different from zero. I really don't understand which is the rationale of having zero net wealth for poor households and having the stock of deposit equal to the stock of the loans they get from banks. In a way, it would imply saying that poor households do not make any savings because they spend all the entire income. Fine. And if so, which is the purpose of getting indebted with banks if they then park their loans in deposit? So this is really something that is not clear to my mind. There is something else which is puzzling, not really in terms of stock flow consistency, but in terms of accounting. In this sense, there is one of the two crucial equations in the paper, one in which the good market equilibrium, you include government expenditures comprehensive of interest payments. This is very much unusual in the sense that in general, when you talk about the good market equilibrium, you include public expenditures on goods and services, but not interest payments on government debt. Interest payments on government debt is just a transfer. Obviously, transfer do affect income. Fine. Obviously, do affect household consumption because they affect income. But these are transferred. They do not give rise to the creation of value added. So I really don't understand why you include interest payments on government bonds in the good market equilibrium equation. And by the same token, I saw that you include that equation in your presentation. It is equation 2 in your presentation, equation 10 in the paper. You actually describing the evolution of the net foreign financial position connected to the trade balance, not really the current account, because you have the difference between imports and exports, which is just part of the current account. It is the trade balance, not the full current account. So really, these are something which is not clear to me. And one more point. Then in your reply, if you go back to your slides, I think, sorry if I'm a little bit picky, but this might be useful when it will come to the next version of the paper and perhaps submission to journal. I think that your theorem 1, which is equation 8 in the paper, or no, sorry, theorem 1 in the presentation, which is also numbered equation 8, there is a problem with signs, because signs on the left-hand side of that equation very likely are wrong. There is a minus sign connected to positive entries in your equation. So it's no way that that equation could be fulfilled. Just give a look to that. I think this is something I noted also reading the paper. But anyway, so this is something we can discuss later when you respond. Very quickly, final point. I would also say that there is one crucial point in one of your exercises in a pure floating regime, which is the fact that you put together two different things, which is domestic debt and foreign debt, denominated in a foreign currency. This is not a problem in the fixed exchange rate regime, because you could assume the nominal exchange rate is 1, so de facto they are exactly the same thing. But with a flexible exchange rate regime, this is not this case any longer, because there is the variation of the nominal exchange rate. So you can put these two things together. It is like apples and pears, only if you use the nominal exchange rate, only in nominal terms. And therefore, I think that the mechanism you went through in your paper to identify the final equation, giving us public debt sustainability in a pure free-floating regime, is too much oversimplified. Is too much oversimplified because I think you run the risk of putting together things which cannot be combined unless in nominal terms. I don't know if I have one more minute, just one more comment. Sometimes you talk about debt sustainability, which is a different concept with respect to debt stability, because you come to some equation in which you say only a primary deficit is consistent with debt sustainability. Well, no, it is consistent with debt stability. If you have a primary surplus, you have a declining debt to GDP ratio, which is absolutely sustainable. It is not stable, but it is still sustainable. So it is important to pay attention to the wording of your paper. I will stop here. Thank you so
Alberto,
much
for the detailed comments. So I suggest, as previously, let's see if we have any comments and questions, and then Collin, I get back to you.
Yeah, no worries, no worries.
So Esteban, please.
Yes, thank you very much. That's a very nice way to read it. I don't know if I understood correctly. I have just 3 comments that I would like to make very briefly. The first one is the importance of the current account in determining debt. And I think for the Caribbean, my experience of having worked in the Caribbean, it's that it's very important, because when you have primary even deficits that coincide with accumulation of current accounts, that's when you have an increase in debt. And that's very important in some cases in the Caribbean, especially the economies of the Eastern Caribbean Currency Union. I think it's quite important. And that brings me to the something that you did not quote, the book in the 1993 book by Godley and Cripps, and some work that has been done on the sustainability conditions by Anadike Dans for Barbados. They compare the quasi-state between, the export ratio and the fiscal stance. I think that could be introduced fairly quickly, and you may get some interesting results in terms of the rate of interest and the sustainability conditions. That's one thing. The other thing is that my experience in Latin America, I think, and this is just to illustrate, because I understand your model simplified, what you have in general is a government decides to increase expenditure. And depending on the level of the debt, you may have an increase in sovereign risk. Increase in sovereign risk has two effects. One on the nominal exchange rate. So the rate of variation of the nominal exchange rate is positively correlated and statistically significant with the rate of variation of MB. The sovereign risk determines also the corporate risk, causes a corporate risk. And there you have some balance sheet effects that are very important in terms of growth and how that affects, because when you have a certain balance sheet effect in terms of firms, you can have a certain debt ratio beyond which, for example, firms do not invest. And so there's a decline in growth, and that has to affect the debt conditions. And the final point is this idea that sometimes is made by MMTers and so on between domestic and external debt. From my point of view, they're completely related, because the problem is not whether you issue in local currency, the problem is who owns the debt in local currency. If foreign investors have a very large presence in the local market, it doesn't matter, because if you have a depreciation or they think you have a depreciation or increasing cost, they're gonna flee. They're gonna go away from that currency. Okay, that's all I wanted to say. Thank you.
Thanks a lot. Eric, please.
Thank you. I really enjoyed this. I just wanted to comment, since you mentioned Barbados a couple of times, that Barbados is unusual in that it has maintained a fixed exchange rate to the dollar for a very long time through fiscal measures. So I just wondered if you put that into your model, if it would throw up something interesting to do it through the fiscal channel. Thanks.
Thank you, Eric. So is there any other question or comment before I get back to Collin? Right, so if not, I also have a very quick question. I know you have a lot of comments and questions.
That's right.
But just very briefly, do your results depend at all on the multiplier, and in particular with how you specify your consumption and investment functions? And do your results could you get different results if you have an endogenous interest rate, where, for instance, interest rate might increase if there is a higher debt or deficit because of the behavior of international investors? Because my understanding is that you argue that if the interest rate is not sufficiently high, we don't have a problem. But what happens if we endogenize it? So that's it. So there are a lot of comments and questions, so feel free to respond to some of them, because we don't have so much time. But over to you.
That's all right. Thank you all for the comments, and particularly Alberto for being very detailed. Let me concede immediately, Alberto, on the point of terminology. You're absolutely right. I need to tidy that up. And the point about the flexible exchange rate case, you're absolutely right. I'm going to consider that immediately. The Theorem 1 sign issue, I have to double check that. That's the big issue. I need to see if indeed there is a sign issue. So I don't want to comment on that. That's something definitely need to double check. The point of matrices, fair enough. The reader is sovereign, right? Sure. Poor households and zero wells. Well, I mean, I'm trying to be consistent as much as I can with some of the so-called stylized facts, right? Savers top 50% or the top 10%, etc. But your points are well taken. The accounting issue. Well, I'm trying to incorporate the wealth effect, right? There are a few papers, both mainstream and PK papers, where we're trying to say actually we get interesting debt dynamics when we account for it that particular way. But I need to think harder about. I mean, I need to think harder about whether or not we're picking up anything there in terms of value added. That's something I need to spend some time on, and maybe others have missed out. If I indicate a current account and I use trade balance as an error, I need to tidy that up as well. I'm thinking trade balance rather than current account. Esteban, yes, you're right about firm level debt. I mean, for example, the BP in my case, the private debt as a share of GDP would be consequential. That can't rise to its limit, and it's not as optimistic as I present. There will be threshold effects. I completely agree, and that's of course possible extensions. I've been trying to get a copy of the Godly Crips book. that's a problem. But I am aware of the Dan's paper about fiscal stance, and there's a CJE version to that paper. I don't know if that's the one you're referring to. But I am aware that there's this big debate about twin deficits, whether it's fiscal side or the current account side. Eric, yes, I'm close friends with the former governor of the Central Bank of Barbados, and he's obsessed about primary surpluses being the solution or the answer to permanent pegs. We have an ongoing conversation about whether or not we need a surplus to get that, or whether it's some kind of smaller fiscal deficit. I mean, that's one of the motivation for this particular paper. Yannis, my results do not depend on the multiplier. I don't get into those specific details, but I think is a strength of the paper. Yes, one of the weaknesses, I do not endogenize the rate of interest, and that's something I want to do going forward. I mean, I highlight to the mainstream guys that are trying to show that much depends on the stock of debt and the feedback on interest rates. So that's something I want to do going forward, providing Alberto is wrong about the sign issue. I need to double check that out, Alberto. That's a good find. I need to double check that. Thanks. All right.
Thank you so much, Collin, for the very interesting paper, and thanks, Alberto, for your great comments. So let's move on to the next presentation by Claudia from Roma Tre University. Claudia is going to talk about the determinants of productivity growth in manufacturing industries in the EU. So Claudia, over to you. Please, if you can share your screen, that would be great. Thanks.
Thank you, Yannis, and thank you everyone for inviting me. Let me share the presentation. Okay, tell me if you can see it.
Yes, we can see it. Okay. If you can also just use full screen.
Okay.
Brilliant, thanks.
Fine. Okay, so I will present this paper that analyzes the determinant of productivity using the local projection technique. And the aim of the paper is to study the dynamic effects on labor productivity that arise from its main determinant, and focusing especially on the direct effect of real wages. The analysis is conducted both at different levels of sector aggregation and from different groups of countries in order to see whether special disparities emerge. I also want to verify the possible asymmetrical behavior of the effect of labor cost changes on productivity, that is, if their effect vary depending on the sign of wage changes. Very quickly, we start by see how labor productivity is differently conceived within different theoretical framework. We all know that in recent decades, many advanced economies have been characterized by an anemic growth of productivity, and we have also seen that spatial disparity emerged between countries and regions also. In the prevalent literature, we have that the slow growth of labor productivity is closely related with the disappointing economic performance of the country. Why? Because in the mainstream theory, as you all know, productivity growth together with the growth of resources, labor, and capital is seen as the determinant of output growth. So within this framework, the gap in the productivity growth between European countries has been identified as one of the main causes of trade imbalances in the Eurozones. And this gap has given the rationale for the implementation of the well-known structural reforms that aims to recover productivity and competitiveness, basically by containing labor costs, increasing labor flexibility, and more generally, increasing the competition in the markets. But why is it so? Why structural reforms should be the way to strengthen productivity? The idea that this is the way is basically based on the mainstream notion of productivity as an indicator of efficiency. So low productivity growth is understood as a sign of productive inefficiency that is caused by some kind of imperfection or rigidities in the market that somehow hinder the smooth work. And in this sense, the only way to strengthen productivity would be to remove those imperfections or rigidities. However, we will see that policies to support labor productivity may vary considerably in content and outcome, depending on how productivity is defined and measured. If we change perspective in a demand-led growth approach where, as you know, aggregate demand determines both actual output and the long-run path of growth, in this framework, the causation is the reverse, in the sense that the accumulation of resources over time is seen as the effect rather than the cause of output growth. And we have that in this way, the growth trajectory of the economy is the result of actualization of output. So we may have that phases of strong demand will induce both resource accumulation and the adoption of technological innovation. In this sense, within this framework, productivity growth is conceived as largely endogenous to the growth of demand and output, something that has been formalized in the well-known Kaldor-Breton law. Within this, having in mind this theory of growth, in which there are no spontaneous mechanisms that ensure the tendency toward full employment, and following the conception of classical economists such as Marx, Smith, and Ricardo, we can interpret income distribution as not resulting automatically from the equilibrium between forces, but instead as basically determined by social and institutional factors. In this sense, the growth of wages may be seen as at least partly exogenous to the growth of productivity. The relation between productivity and wages is bidirectional. So we have that the growth of productivity open up space for the possible growth of wages, but we also have that wages may exert an influence on productivity. And in my work, I focus on this second direction of causation, and especially on the direct effect of wages, in the sense that, of course, wages may exert an indirect effect by fostering or depressing aggregate demand and through it productivity, but they also may act directly, so independently and in addition to the stimulus that come from the growth of aggregate demand. The theoretical reference for the definition of two direct effect of wages is Silos-Labini. It identifies two effects: the mechanization effect, also known in the literature as the Ricardo effect, which acts through induced technical progress, in the sense that an increase in wages with respect to the price of machine gives an incentive to firms to save labor with respect to other inputs. So to introduce labor-saving innovation and increase the mechanization of the process. Then we have the organization effect, which acts through the incentive toward a more efficient use of the existing labor inputs, so which can be achieved through the reorganization of the production process by a better exploitation of pre-existing innovation or the introduction of organizational innovation that allow a more intensive use of the workforce already employed. It is important to stress that both mechanisms are not automatic. They will depend, for example, on the ability of the firms to passing costs on to prices, and they are essentially dynamic. So they are the results of technological changes. Silos is very stressed. Silos stress a lot the difference between his conception, which is the concept of a dynamic substitution between machine and labor, which is understood as an irreversible process that takes place over time and involves changes in technology, versus the static substitution between capital and labor that we find in the mainstream theory, and which concern the continuous choice of firm to change the composition between capital and labor, choosing in a continuum of existing efficient techniques. Let's go to the model that I will estimate, which is the Silo-Salabini productivity equation. We have three determinants of labor productivity growth. One is the extension of the market. Here, the theoretical reference is Adam Smith. Is the idea that we all know that an increase in the market will allow greater division of labor, and so will increase productivity growth through both static and dynamic increase in returns. Then we have the changes in labor cost through the two mechanisms that I have just mentioned. And then we have the effect of investment, which appear to have a negative effect at the beginning, due to the fact that new equipment take time to be used effectively, but then they exert a positive effect on productivity in the medium to long run. The empirical literature has found the general confirmation of Silon's insights, both in single country estimate and studying spatial disparities, either national or regional level. There are also other work that find confirmation of the hypothesis of a positive causal link that acts from wages to productivity. Some work study the indirect effect of wages that goes to aggregate demand, but other studies analyze the direct effect through different models. Let's go to my empirical analysis. I use data from the STAN database of the OECD. It's a panel of 14 European countries over the period 1995-2018, and are annual data for the manufacturing sector of those countries. Then I use a second data set, which is a three-dimensional data set that analyze 8 manufacturing subsectors for the same panel. I start by estimating the Silo-Salabini productivity equation using the local projection technique for the whole manufacturing of my panel. Then, once I have analyzed the effect of each determinant of the equation, I focus especially on the two measures of labor cost, changing the equation how introducing a dummy that identifies episode of wage expansion or wage moderation. And I introduce this dummy in place of the indicator, which is the rate of growth of the wage indicator. And this is to study possible asymmetries of labor cost, of the effect of labor cost, but also to see if there are some differences between the two indicators. And I pass to the three-dimensional panel data set, so the dimension are country sector here, to see if the relations are confirmed at the sectoral level. And I use the same data set, the second, to analyze the different developments in manufacturing indices of three groups of countries: core, East European, and peripheral countries. About the local projection is a technique that allows the identification of dynamic effects that, in this case, on labor productivity, that arise from each determinant separately through impulse response functions that are calculated by estimating the effect over different time of horizons. The variables different from the shock are used as control in the sense that their coefficients do not enter in the construction of the ILFs. The first model that I estimated, the one in equation 1, is a dynamic fixed effect model where we have the dependent variable, which is the cumulative change of labor productivity between time t-1 and time t plus h. W is the variable of interest, which is different in each equation. Then we have the lagged value of the dependent variable and a set of control variable which include all the determinant of the Silo-Salabini productivity equation different from the variable of interest. When I focus on large and long-lasting changes in wages, so a period of expansions and moderations, what I do is that I insert a dummy which is equal to 1 if there is an episode of expansion or moderation and 0 otherwise, in place of the continuous variable of the growth of the labor cost indicator. Again, the control variables contain all the other determinants of the productivity equation. Expansion are defined as those years in which wage growth is higher than its country mean by at least 1 standard deviation, so sizable changes, and it's higher than 1/2 of the country mean in the year preceding the expansion. So we are sure we are not looking at a standalone data. For moderation, we have the same 2 conditions, but in addition, we consider moderation also, of course, period in which wage growth is negative for at least 2 consecutive years. Finally, I apply the equation 3. The modeling equation 3 is basically the same of equation 1, but applied to a 3-dimensional panel where we have, in this case, a bilateral fixed effect, which is constructed as a country year effect. So we are holding country fixed in each year, and the within transformation is made in a way that allows the comparison between sectors. The same model is used then for analyze spatial disparities between the 3 groups of countries, core, Eastern European, and Mediterranean. Okay, here we have the results. Each graph represents one of the determinants. We have that the Ceylon's insights are confirmed with the exception of investment on the bottom right, since it's barely significant. While we have that both measure of labor costs exert a positive persistent effect on labor productivity. In particular, we have that 1% increase in wage growth generates an average increase of about 4% in the cumulative productivity growth over 10 years. That is the one arising from the growth of value added, which is on average equal to 5.4. Then the second step of my analysis is when we focus on the expansion and moderation. Here we have only the 2 indicators of labor costs, so organizational effect in the left column and the mechanization effect in the right one. And we have on the first line positive shock, on the second line negative shocks. As you can see, again, we have that the effect of large wage changes on productivity is confirmed, and it is persistent over time, and it does not change sign over time. So also a prolonged and intense growth of wages may exert a positive influence on the growth of. And on the other hand, it's also true that a prolonged moderation of wages is detrimental for productivity growth. There are also some asymmetries that arise. Basically, both effects show a more pronounced impact in negative episodes. The mechanization effect need to be correct for the nickel bias. And it also emerged a different timing of the 2 indicators, which is something very interesting because in the literature always it's not easy to understand if we manage with these 2 indicators to capture different effects. And what we have here is that if we look at positive shock, the organization effect acts mainly in the short run, while the mechanization effect is great in the medium to long run, something that also with a completely different technique also Silos has found in his works. Then we move to the 3-dimensional data sets, and we see that all the relations are confirmed at the sectoral level. Also the poor significance of investment, and we have, for example, for the organization effect, that the cumulated effect over 10 years is almost doubled. Now we can see that 1% increase in wage growth generates an average increase of 5 to 8% in the cumulative productivity growth over 10 years. Why it is important that we found confirmation of the relation not only at the country but also at the sectoral level, because when we work in aggregate, we may have that an increase in wages in some sector determines an increase in demand, which in turn cause higher productivity also in subsector where wages have not increased. Of course, we control for this with the Smith effect, but still having the confirmation of the relation at the sectoral effect ensure us that we are capturing a direct effect of wages. So an increase in wages in a specific sector increase productivity in that sector. Finally, the comparison within different group of countries. Okay, the first line, I don't know why the picture is changed, but the first line are core countries. The second line are Eastern European countries. The bottom line are Mediterranean, South periphery countries. And each column is a determinant. Again, we have that investment are barely significant, while the Smith effect, value-added effect, is always positive and persistent in all group of countries. We observe some spatial disparities exactly in the effect of labor cost. In core countries, we have that labor cost, both measure of labor cost, exert a increasing a positive cost effect on productivity. While if you look on the, let's see, Eastern and Southern peripheries, we have that the organization effect is quite high and positive and persistent, while the mechanization effect is very low, and in the southern countries, barely significant, is significant only in the first year. So we see that this is already said, that by summing up, productivity in the two peripheries seems to be more sensitive to the so-called organization effect. So this can be interpreted as the fact that the easiest ways to increase productivity in those countries is to reorganize the workforce rather than increase the mechanization of the production process. On the other hand, the more persistent effect of wage shocks in core countries can be explained by a higher research intensity. So a general higher ability of this country to react in increasing cost, and especially labor cost, by introducing innovation and increasing the mechanization of the process. Summing up, we have also seen that when looking at wage expansions and moderation, they exert a persistent effect of productivity that does not vary in sign over time. And we have seen a different timing between the two indicators that can be interpreted in the sense that at the beginning, when wage increased, the first reaction of first may be to reorganize the workforce, but then after subsequent wage increases, firms may be induced to implement other kind of productivity enhancing strategy in a longer term. And what we get from this analysis is that even an intense prolonged wage growth is not harmful to productivity. When we look on negative shocks, we can see that there is a persistent negative effect on productivity. So a prolonged wage stagnation can induce firms to make an extensive use of the labor input, so and turn an initial short-run reaction into standard practice. Indeed, the effect is confirmed also in the long run. The fact that wage stagnation is detrimental to productivity confute, of course, the idea that cutting wages is one of the best way to increase competitiveness and productivity. So, the analysis suggests that a strategy of growth that is based on structural reforms is in danger, so that aim to increase productivity by cutting labor costs is in danger of failing, not only of failing in its own purpose, but also achieving the opposite effect. On the other hand, policies that address higher growth wages may be more effective in the growth of the economy, because they will, on the one hand, act as a stimulus for demand growth, and on the other hand, they will provide an incentive to innovate for firms and thereby increase productivity. Attention.
Thanks a lot, Claudia, for the very clear presentation. The results look really interesting. So now we have Armanda, who is going to provide some comments. Please.
Yes. First of all, let me thank the organizers for inviting me to this event, and also let me congratulate all the organizers for having rebuilt, let's say, this network of Post-Keynesian. I think is very important for young scholars to build network, to know and to circulate ideas and research. So thanks. Going to the work of Claudia will be very short, given the time, and also to leave the possibility to other people to intervene. First of all, I really congratulate you for your research and in general for the line of research that you are developing, because in these years we know each other. So I think you are touching very extremely relevant issues from an economic point of view, from a theoretical point of view, from a political point of view. So thanks really, and congratulate. There is no need to explain the aim of your paper. You are very clear and clear-cut. I just want to say that I really appreciate this attempt to, let's say, looking at very relevant contemporary issues, exploiting also the heritage coming from classical economists like Smith and Ricardo, and then masterly, of course, reformulated and elaborated by Silos Labini. According to me, this paper is interesting for different perspectives. First of all, I'm not an expert, I'm a macroeconomist, and I'm not an expert of this model, so I leave the other or the audience to make questions on this point. But let's say from my perspective, it's interesting because it tries to combine a macro perspective with a more sectoral point of view, because there is this a comparative perspective of European countries, and also because of the introduction of this different moment of expansion and recession. So let's say you are trying to provide a different angle of analysis in order to understand and explain the determinants of productivity, stagnation, let's say, because it's not growing at all with respect to the main factor that you believe relevant, that is wage dynamics. So let's say just a few comments. The strength, as I said, is this idea of trying to combine the macro perspective with a more sectoral analysis, even if, as you say very clearly in the paper, you depart from the idea that aggregate factor, demand, let's say aggregate demand is the key to understand productivity dynamics. And I agree that, absolutely agree that wages are fundamental to understand that, let's say, the relation between capital and labor, and so strategies of investing and innovating. But I think that maybe in order to strengthen more further your reasoning, it might be useful to take into account some other complementary factors that actually play a role, as we know, and if we take into account a more firm-based analysis, where actually innovation takes place and where productivity statistics are, let's say, really created and determined. In this sense, I think that you try to do this a bit with this organization effect. You try to integrate this level of analysis that is more micro-based, but the way you then measure this organization effect is again related to wage. So at the ratio between wage and output price, whereas I think that you might think to introduce other proxy, other measures of organizational change and innovation, it actually can have an important impact on the way the productivity is determined and it tends to increase or not, because otherwise there is the risk to end up with a deterministic perspective, on how productivity Of course, there are clear channels, but we believe that the way things develop is not deterministic, and the technological change also is actually shaped by innovative capabilities, firm strategies, power relations, and so on. So maybe you might find some other elements. Of course, for a more micro perspective, this is related to knowledge accumulation, to the presence of that is difficult to proxy in macro analysis, but maybe R&D department, technological paradigm at sectoral levels, some factors, some variables that could help you to better assess the differences that I think you are interested in discovering and underlining. And so related to this, this brings me to the second point, that is the institutional dimension. You said in the paper and today that, of course, this is the period that you analyze is a period characterized by important structural reform. And we know that wage stagnation is actually not only, it also related to the type of employment that has been rising in the last few decades, non-standard type of employment, temporary works and temporary jobs and so on. And there is a part of literature that is more maybe in the between post-Keynesian and more evolutionary perspective that has tried to see how an increase of temporary employment, flexible workforce also can impact on innovation, innovative capabilities and productivity. So maybe this is a bridge that might be useful in your analysis, given that also wage relates to regulation or labor regulation. Because I think that is important to stress that, of course, wage is a fundamental channel, but then there is also the capability of firms to displace and fire labor, exploit a very, let's say, elastic factor of productivity that is not only a factor of productivity, is also a factor of production, but is also a body of knowledge. So the possibility really to fire and hire workers can also impact then the decision to innovate, the organization effect, the mechanization effect that you are studying with respect to wages. And then finally, on the role of time, in the paper you discuss a lot about short run, medium run, long run effect of your main channels of interaction, but maybe from the reader perspective that is not so acquainted with the macro model, it's difficult to get an interpretation for these different time settings. So given that the period that you study is so intense, 20 years characterized by crisis, structural reform, etc., if you might also be a bit more detailed in the way you describe the time horizon and the different impact of your variables from a time perspective. And then this is really very short suggestion. Given your effort in building this database, it might be interesting and useful for the reader to have a descriptive statistics at the beginning where you show an overview of the different wage levels of the countries that you analyze and productivity statistics, just to give the even more the desire and curiosity to read the paper. Thank you very much.
Thank you so much, Armanda, for the great comments. So we have run out of time more or less, but we can spend 5 minutes or so in order to get some comments and questions from the audience. So please, if you have any question or any comment, raise your hand. Esteban, please.
I can't.
Yes, thank you. That was a very interesting paper. I didn't read the paper, but I just have one question. I've worked a little bit in labor productivity in the case of Latin America, and I compared to developed countries' productivity over time. And productivity seems to be, at least in the case of Latin America, very pro-cyclical. And so in the other countries. So and in general, what I've seen is the productivity increases less than the let's say GDP per capita rate of growth, and falls less than GDP per capita rate of growth. And how do you take into account this factor? Because I think in the case in Latin America is very important because we're subject to external shocks. And so it affects the rate of growth, GDP per capita, and then it affects productivity. So you have a tendency in productivity, let's say the decline that you see in the United States, Europe, and then you see also the cyclical fluctuations. How do you integrate both? Thank you.
Thank you. Eric.
Thank you. A couple of quick comments. One is that it is possible, and some would posit that the causality at least partly goes in the other direction from a change in labor productivity right to setting the wage, therefore based on that from conflict, and how do you disentangle that? The second one, just to emphasize what Amanda said, is another data set you might consider is the enterprise surveys. Basically, what I was hearing you do is generate some hypotheses about what was going on. And at least for recent years, you might be able to test some of those by looking at the surveys. Just a thought.
Thank you, Eric. Alberto.
Claudia, first of all, thanks a lot for your presentation, the paper, very interesting. Something that it is in my mind, has been in my mind for quite a long. So, which is the role of different countries' productive structures in making a high wage strategy affordable, in the sense that perhaps your results in terms of different dynamics, different responses in different areas of the European Union is consistent with my question in the sense that countries with a stronger productive structure could possibly react better to increases in wages with respect to countries with a much more fragile productive structure, like could be Italy, Greece, Portugal, in which labor-intensive, low-skill labor-intensive sectors could just move away to their countries. So the outcome in terms of productivity dynamics is just the recomposition of their manufacturing, because some sectors decide to move away whilst others can remain in the country if wages are higher. Thank you so much.
Thank you, Alberto. Is there any other question or comment? Okay, if not, just a quick thought, primarily for future research. So in post-Keynesian models, we often have this issue that we have a wage-led regime, we have an increase in wages. This increases output, which tends to increase employment. But at the same time, in line with your results, we have that the increase in wages or even the increase in output also increase productivity. And we don't know a priori whether there will be an increase or decline in the employment rate. And this is another type of interesting discussion from a policy perspective. So perhaps another interesting investigation for you would be also to look at the employment effects, because this could also inform this theoretical debate. So just a quick thought. So please answer any of the questions that you have been asked, perhaps in the next 2 or 3 minutes, and then we can wrap up. Thanks a lot.
Okay, thank you so much, everyone, for the interesting comments, and thank you, Armanda. I will try to go quickly since we don't have a lot of time. For what concern the organization effect, Armanda, I completely agree with your point, and it is exactly something that I want to study in further research, in the sense that I want to find some different indicators and measures, using also more indicator that somehow can catch what the organization effect that try to measures. So it depends, of course, the level of the analysis, micro or macro level, and depending on which indicator I will find, this is a point that I am exactly studying it. I will also look to some kind of indicator of working time, I think would be interesting. So for what concerns this institutional dimension, I completely agree that the flexible labor as the increasing flexibility of labor as an effect. Indeed, in another work, which I cite in the paper with Antonella Polumbo, Permanent Scars, we have exactly an estimation of the Silo-Salabini productivity equation, which we include a measure of temporary labor with respect to not temporary labor. And it has an effect, a negative effect on productivity. So then for what concern the other two comments, they are good suggestions. So try to describe better what I mean for the short, medium term, and descriptive about the descriptive statistic. You are not the first one who tell me this, so maybe I should put something. I'm always afraid that the paper becomes too long, but I think it's interesting. So thank you so much. Esteban, for what concern procyclicality of productivity, if you mean in somehow taking into account the endogeneity of productivity to output growth, the way in which I control for it is something that I didn't post in the presentation, and it is that I also made an instrumental variable local projection estimation using as an instrument. I regress the indicator on its best value. I take the error, and this error together with the other determinant I use as investment. And the same is done to answer to Eric's question about reverse causation. Of course, I'm aware of the fact that the relation goes in two directions, and this is exactly the way in which, first, one thing is that I have a dynamic panel, so I have past value of productivity among the regression, and I do not have autocorrelation in the error. So this would be already something to say, I can say this, that I'm looking at that direction of causation. But in addition, I also do this instrumental variable estimate. So thank you. Alberto, I agree with your point. I mean, it seems exactly like this. It seems that my results are in line with your view. So maybe something that I should point out in the paper. So thank you. And finally, Yannis, of course, it would be interesting to go in the direction of that debate. It can be something that can be done in further research. So thank you.
Thank you so much, Claudia, and many thanks to everyone, all the presenters, all the discussants for the great comments. And I think all the presentations were excellent, and I think this illustrates that Post-Keynesian economics has a bright future. So we're very glad that you joined us today. Let me say a couple of things about the future. I mean, first of all, we are now working with the Italian Post-Keynesian Network in order to have some additional events, and one of them will be actually very soon. And it is the STOREP conference that is going to take place in Bari. So if you happen to be in Italy, you can join the sessions that we have co-organized there. So I just shared the link. And we are thinking about having some additional events in the future. Of course, we welcome any ideas about how we can strengthen the links between the Italian Post-Keynesian Network and the Post-Keynesian Economics Society. Let me also thank Federico, Alberto, Eugenio, Maria, and Daniele, who were in the organizing committee. And perhaps before we finish the webinar, I would like to hand over quickly to Federico or anyone else in the organizing committee who might want to say something about the future. Federico?
Yes,
please.
You hear me?
Yes, very well.
So I will be very quick because we run out the initial time. But you said mostly of what I wanted to say. So we are actually very happy as an Italian Post-Keynesian network for this collaboration with the Post-Keynesian Economics Society. As you said, this was actually the second edition of the webinar, which took place already last year with other presentations, of course. And I remember that at the end, you gave me the word. And I said that I wish, for instance, that this collaboration could last also and could be structuralized in the following years. So this second edition is the proof that we made it. And so we are very happy. Just a few words on some of the STOREP conference. There will be, as you said, a joint session, IPKN, PKES. There will be also the ADEC, so the French Post-Keynesian Association, Association de Développement des Études Keynésiennes. And I insist on this point because I think one of the largest achievements that we had in our cooperation is to go beyond our geographical limit. And so the fact of being able to create sort of European network of Post-Keynesian association, I think is very important. It's important because I think that one of our main goals is to improve the visibility of young researchers, which already are young researchers, so they struggle as young researchers and they struggle twice more because they are heterodox. And so being able to create a European network is a way also to improve even more this visibility. And so I think I'm talking on behalf of the IPKN to say that we are very happy of this cooperation, and we also hope that we can develop it further in the next years. So thanks for coordinating this event today, and see you in the next.
Thank you, Federico. I think last time you also told us that you would do whatever it takes to continue this collaboration. So I think we managed to do that. But yeah, we are going to keep you posted about future events. And as I said before, we also welcome ideas about other initiatives. So let's wrap up. Thanks everyone who joined today. It was a great discussion. We look forward to next interactions. Enjoy the rest of your day, and hopefully see you soon also in person. Bye-bye. Thanks a lot.
Thank you. Bye.
Bye, everyone.
Bye.